Are you working hard? Are you doing everything right? You get your paycheck, you pay your bills, and with whatever is left, you diligently put it away. You squirrel it into a savings account, patting yourself on the back for being responsible. You watch that account balance. $1,000, $2,000. It creeps up. 2,100, 2,150. You feel safe. You feel smart. But what if I told you that this feeling of safety is an illusion? What if I told you that by safely saving your money, you are all but guaranteeing that you will lose? My name is Ben, and today we are not just talking about a simple tip. We are talking about the single most important shift you must make to build real wealth. We are talking about the fundamental difference between working for your money and having your money work for you. And it all hinges on one concept, a concept so powerful it's been called the eighth wonder of the world. We're talking about compound interest. But before we get to the magic, we have to talk about the villain, the silent, invisible enemy that is eating your savings account for breakfast every single day. We need to talk about inflation. Right now, your savings account is probably paying you, what, maybe 1% if you're lucky? Maybe 4% in a high-yield account if you're really on top of it? But at the same time, the price of everything is going up. Gas, groceries, housing, coffee. This is inflation. Let's be conservative and say inflation is 3% per year. If your money is in a checking account earning 0% and inflation is 3%, you are losing 3% of your purchasing power every single year. Your money isn't standing still, it's shrinking. If your money is in a savings account earning 1% and inflation is 3%, you are still losing 2% every year. That $10,000 you saved feels good, but in 10 years, it will only buy what $7,000 or $8,000 buys today. This is the saver's trap. You work your entire life to fill a bucket while inflation is poking holes in the bottom. You can never save your way to retirement. You must find a way to make your money grow faster than inflation. And that, my friends, is where our hero enters the story. That is where we stop saving and start investing. Okay, let's start simple. What is interest? Interest is the fee you get paid for letting someone else, like a bank or a company, use your money. There are two types of interest. The first one is boring. It's called simple interest. Let's say you invest $10,000 and get 10% simple interest per year. In year one, you make $1,000, 10% of $10,000. Your total is $11,000. In year two, you make $1,000 again, 10% of the original $10,000. Your total is $12,000. In year three, you make $1,000 again. Total is $13,000. It's predictable. It's linear. It's slow. Your interest never does any work for you. It just sits there. Now, let's talk about the magic. Let's talk about compound interest. Compound interest is interest earning interest. It's an exponential idea. Your money has a baby, called interest, and then that baby grows up and has its own babies. Let's use the exact same numbers. $10,000, 10% interest per year, but this time it compounds annually. Year one, you invest $10,000, you earn 10%. That's $1,000. Total, $11,000. No different from simple interest. Yet. Year two. Now your starting amount isn't $10,000. It's $11,000. You earn 10% on the entire amount. What's 10% of $11,000? It's $1,100. Your new total, $12,100. Look at that. You just made an extra $100 from nothing. That was your interest from year 1 doing the work. Year 3, you start with $12,100. You earn 10%. What's 10% of $12,100? It's $1,210. Your new total? $13,310. With simple interest, you'd only be at $13,000. Now you're at $13,310. It doesn't seem like much, does it? An extra $310. Who cares? This is the part where most people get bored. They stop and say, "This isn't working." They don't see the magic, because the magic isn't in year 3. The magic is in year 30. Let's fast forward. At year 10, our simple interest friend has $20,000. 10,000 plus 1,000 times 10 years. Our compound interest investor has $25,937. At year 20, simple interest, $30,000. Compound interest, $67,275. Now it's getting interesting. The gap is widening. At year 30, simple interest, $40,000. Compound interest, $174,494. It's not even a competition. At year 40, simple interest, $50,000. Compound interest, $452,592. This is the snowball effect. Imagine you are at the top of a very, very long snowy hill. You start with a tiny snowball. That's your first $1,000. You give it a push. As it rolls, it picks up a little snow. At first, it's just small. It's not impressive. It feels like a lot of work for nothing. This is the first 5 to 10 years of investing. It's the flat part of the J-curve. But as the snowball gets bigger, its surface area increases. And because it's bigger, it picks up even more snow with every rotation. And as it picks up even more snow, it gets even bigger, letting it pick up even more snow. This is compounding. The growth isn't just added, it multiplies. In our 40-year example, do you know how much you contributed? $10,000. Do you know how much interest you earned? Over $442,000. Your money did 44 times more work than you did. That is the goal. That is financial freedom. So, you're convinced. You want this compounding machine to work for you. Great. This machine has 3 main levers you can pull. Understanding these will change how you think about money forever. The levers are 1. Time. How long your money is invested. 2. Amount. How much money you invest. And 3. Rate. Your rate of return, or how fast it grows. Let's break them down. And I'll tell you right now, one of these is infinitely more powerful than the others. Lever 1. Time. The magic wand. This is it. This is the secret ingredient. This is the one lever you can never get back once it's gone. The power of compounding doesn't really show up in a year or two. It shows up over decades. Let me tell you a story. The story of 2 twins, Savvy Sarah and Late Luke. Savvy Sarah starts investing at age 22. She's smart. She invests $300 a month. She does this for just 10 years. At age 32, she stops. Life gets busy. She has kids, a mortgage, whatever. She stops adding new money. She never adds another dime. Her total contribution, $300 a month for 10 years, is $36,000. She just leaves that money in the market, growing at an average 9% return. Now meet her brother, Late Luke. Luke lives it up in his 20s. Cars, vacations, avocado toast. He doesn't invest a penny. At age 32, he has a mild panic attack. He realizes Sarah was right. He decides to finally start investing. He also invests $300 a month. But to catch up, He doesn't stop after 10 years. He keeps investing and investing and investing. He invests $300 every single month from age 32 all the way to age 65. That's 33 years of continuous investing. His total contribution, $300 a month for 33 years, is $118,800. So, to recap, Sarah invested $36,000, and only for 10 years. Luke invested $118,800, more than 3 times as much money. Who has more money at age 65? At age 65, Luke, who invested over $118,000 of his own money, has $695,000. Not bad. But savvy Sarah, who only invested $36,000 and stopped at age 32, she has $945,000. Read that again. She invested $82,000 less and ended up with $250,000 more. How? Those first 10 years, her money had an extra 10 years to compound. Her interest started earning interest so early, her army of dollar babies was massive before Luke even showed up to the fight. The lesson? It is better to invest a small amount for a long time than a large amount for a short time. The best time to start was 10 years ago. The second best time is right now, today. Lever 2. Amount. The fuel. This lever is more straightforward. The more money you add to the snowball, the faster it grows. It's the fuel for the fire. Let's go back to our $10,000 example, growing at 10% for 30 years, which gave us $174,000. What if, instead of just one $10,000 investment, you invested $10,000 and then also added $100 every month? That's just $25 a week. That's one dinner or a few fancy coffees. That $100 a month over 30 years is an extra $36,000 out of your pocket. So our original $174,000 plus the $36,000 should be $210,000, right? Wrong. You forgot about compounding. That extra $100 a month was also compounding. By adding just $100 a month, your 30-year total doesn't just go up by $36,000, it explodes. $10,000 initial plus $0 per month equals $174,000. $10,000 initial plus $100 per month equals $361,000. You more than doubled your final amount by adding a relatively small monthly contribution. This is why your savings rate, the percentage of your income you invest, is so critical. Find an extra $50. Find an extra $100. Automate it. Every single dollar you add isn't just a dollar. It's a seed for a future money tree. Lever 3. Rate. The accelerator. This final lever is the rate of return, how fast your money grows. This is where what you invest in matters. A savings account gives you a 1% or maybe 4% rate. A government bond might give you a 5% rate. The stock market, like an S&P 500 index fund, has historically returned an average of 9 to 10% over long periods. Let's see the difference. You invest $500 a month for 40 years. At 5% return, very conservative, maybe bonds, you'd have $764,000. Amazing, you're a retiree. At 9% return, historical stock market average, you'd have $2,129,000. Read that again. A 4% difference in your rate of return didn't give you a 4% different outcome. It gave you a 178% different outcome. It's the difference between retiring and retiring rich. This is why we can't just leave our money in safe savings accounts. The safety of 1% is costing you millions in future wealth. We are accepting a 100% chance of a small gain in exchange for giving up the possibility of a massive gain. This brings us to the biggest question, the one everyone is terrified of. I can hear you. Ben, this sounds great, but the stock market, that's not investing, that's gambling. My uncle lost all his money in 2008. This is the single biggest psychological barrier. We have been trained to see the stock market as a casino, and if you treat it like one, it is. If you're day trading, if you're buying meme stocks, if you're trying to time the market, you are gambling, and you will probably lose. But that is not what we are talking about. We are not gamblers. We are owners. When you buy a stock, you are buying a tiny, fractional piece of a real-life, profit-generating business. You become a part owner of Apple, of Amazon, of Coca-Cola. Do you think those companies are going to be more or less valuable 30 years from now? But Ben, the market crashes. Yes, it does. Absolutely. Look at this. This is a chart of the last 50 years. It's scary. It's volatile. Here's the 2000 dot-com bubble burst. Here's the 2008 financial crisis, a 50% drop. Terrifying. Here's the 2020 COVID crash. This is volatility. It's the price of admission for getting those 9 to 10% returns. But there's another word for this, risk. And we need to redefine risk. Is risk watching your portfolio temporarily go down 30%, knowing that historically it has always recovered to new all-time highs? Or is risk guaranteeing your money loses 3% to inflation every single year by hiding it in a savings account? I'll take the temporary volatility over the guaranteed permanent loss of inflation any day. But Ben, it's too complicated. This is the second fear. I'm not a finance bro. I don't know how to read a P/E ratio. Guess what? You don't have to. In fact, studies show that active investors who try to pick winning stocks fail to beat the market average 90% of the time. You don't need to pick the winning stock. You just need to buy all of them. This is called an index fund. An S&P 500 index fund, like VOO or FXAIX, is just a basket that automatically buys you a tiny piece of the 500 biggest companies in America. You aren't betting on one company to win. You are betting on the entire American economy to grow over time. That is the safest, most reliable bet in modern history. It's one purchase, it's simple, it's diversified. This one invention, the index fund, makes investing accessible to everyone. No genius required, just patience. But Ben, I don't have $10,000. This is the final and most common excuse. I can't invest, I'm broke. This isn't an all-or-nothing game. Remember our late Luke example? He started with $300 a month. Remember our amount lever? We saw the power of $100 a month. Today, with fractional shares, you can start investing with $5. You can buy $5 worth of Apple. You can buy $10 worth of an S&P 500 fund. The goal isn't to be perfect. The goal is to start. Start with $25 a month. Automate it. Then, when you get a raise, make it $50. When you pay off a debt, make it $100. The habit is more important than the amount. Start the snowball rolling. Even a tiny snowball, given 40 years, can become an avalanche. Okay, you're fired up. You've conquered your fear. You're ready to stop being a saver and start being an investor. What do you actually do? Right now, here is your 4-step plan. This is the exact roadmap. Step 1. Build your Don't Panic Fund. Wait, Ben, didn't you just spend 20 minutes yelling at me not to save? No. I told you not to hoard all your money in a savings account for the long term. You still need a short-term buffer. This is your emergency fund. This is 3 to 6 months' worth of your living expenses. This money does sit in a high-yield savings account. It does not get invested. Why? because this is your don't panic fund. When your car breaks down or you lose your job, you don't want to be forced to sell your investments, especially if the market is down. You pay for the emergency with your savings, and you leave your investments alone to compound. Do not skip this step. This is the foundation. Step 2. Open the right compounding machine. You don't just invest. You have to invest inside an account. Think of the account as the wrapper or the greenhouse for your plants. And the U.S. government gives us some amazing tax-advantaged greenhouses. If your job offers a 401k with a match, start here. A company match is free money. It's an instant 100% return. If your company match is 5%, you must put in 5%. Not doing this is literally throwing away part of your salary. Next, open a Roth IRA. This is the best one for most people. You put after-tax money in. That means you pay taxes on it today, but then it grows and compounds for 30, 40, 50 years, and when you take it out in retirement, it is 100% tax-free. All of it. The $900,000 you grew, you pay zero tax on it. It is the most powerful wealth-building tool the government has ever given us. Finally, a taxable brokerage account. This is for after you've used your 401k match and after you've maxed out your Roth IRA. It's a normal investment account, no special tax breaks, but it's flexible and has no limits. Step 3. Buy the snowball. Okay, your greenhouse, the Roth IRA, is open. What plant do you buy? We talked about this. We are not picking stocks. We are not gambling. We are buying an index fund. You will go to a brokerage like Fidelity, Vanguard, or Schwab, and you will buy one fund, something like VTI, Vanguard Total Stock Market Index, or VOO, Vanguard S&P 500 Index. One buys you the whole U.S. market. The other buys you the 500 biggest companies. Don't overthink it. They're 99% the same. Pick one. That's it. You are now more diversified than 90% of hedge fund managers. Step 4. Automate it. The most important step. This is the final secret. Do not trust your human brain. Your brain is weak. It panics. It gets greedy. It forgets. Do not ever wait for the right time to buy. Do not ever wait to see what the market does. Set up an automatic transfer. On the first of every month, take $100 from my checking account and automatically buy $100 of VOO in my Roth IRA. This is called dollar cost averaging. When the market is high, your $100 buys fewer shares. When the market is low and everyone is panicking, your $100 automatically buys more shares on sale. It removes all emotion. It forces you to buy low. You set it, you forget it, and you let the machine do the work for 30 years. We're back where we started, that piggy bank. It feels safe. It feels comfortable. But now you know the truth. You know about the inflation monster eating it from the inside. You know about the saver's trap. And right next to it, there's a small, tiny snowball. It's labeled investing. It looks pathetic. It looks risky. It looks small. But you've seen the future. You know what that snowball becomes. You know about the magic of the J-curve. You know about Sarah and Luke. You know that 40 years from now, that snowball is the mountain. The choice is yours. You can spend the rest of your life working for your money, trying to fill a leaky bucket. Or you can take a different path. You can build a system, an automated machine that puts your money to work for you. It starts today. It starts with $50. It starts with opening that Roth IRA. It starts with smashing that piggy bank. Thanks for watching this masterclass. If this helped you, please hit that like button and subscribe for more videos to make your money work for you. It's never too late to start. Go build your snowball.